What you are about to hear may permanently alter how you think about markets, pricing, and the very definition of value itself. Because at this precise moment in time, two entirely different versions of reality are unfolding across the global financial system. They cannot both be correct, yet they are both happening simultaneously. On one side of the Pacific Ocean, silver is being exchanged as a scarce, indispensable industrial input at prices that reflect desperation and urgency. On the other side, it is still being treated as an abstract financial instrument priced by screens, algorithms, and leverage. The contradiction between these two realities has now become impossible to ignore. In the opening trading days of 2026, the global silver market experienced an event that conventional economic theory insists should never occur. For decades, investors, policymakers, and academics have operated under the belief that commodities trade at a single unified global price. According to this belief, any discrepancy between markets would be instantly erased through arbitrage, ensuring price efficiency. That assumption has now been openly challenged. Physical silver trading in Tokyo is changing hands at prices near $130 per ounce, while futures prices displayed in New York remain near $75.50. This is not a momentary glitch or an isolated transaction. It is a persistent and widening structural split. To understand how such an extreme divergence became possible, we must examine how silver pricing has functioned for decades. Since 1974, the primary mechanism for silver price discovery in the Western world has been the futures market operated by the Commodity Exchange Division of the New York Mercantile Exchange. This system is built on standardized futures contracts that allow participants to agree today on the purchase or sale of a specific quantity of silver at a predetermined price on a future date. In theory, these contracts exist to facilitate hedging and efficient price discovery. In practice, the vast majority are never settled with physical metal. Instead of taking delivery, most traders simply close or roll their positions before expiration. This behavior transformed the silver market into a paper-based system where the notional value of outstanding contracts vastly exceeds the quantity of physical metal available for delivery. Over time, this imbalance grew steadily larger. The entire structure relied on one critical assumption: that only a small fraction of contract holders would ever demand physical delivery. As long as this assumption held, the system appeared stable. For many years, it did hold. Speculators preferred cash settlement. Industrial users relied on established supply chains. Physical delivery was the exception, not the rule. But this equilibrium began to erode following the global financial crisis of 2008. That event exposed systemic counterparty risk throughout the financial system. Investors who witnessed the near collapse of major banks began questioning the safety of paper claims in general. Physical precious metals, which carry no counterparty risk, became increasingly attractive as a form of financial insurance. This shift accelerated dramatically after 2020. In response to the pandemic, governments worldwide expanded monetary supply at unprecedented levels. Between 2020 and 2024, retail demand for physical silver coins and bars surged to record highs. This wave of buying steadily drained accessible inventories from Western vaults. The registered inventory category, which represents silver available for delivery against futures contracts, declined sharply. From peak levels, registered inventory fell by approximately 70% over 5 years. Despite this drawdown, the paper price remained largely unaffected. Futures markets continued operating as though supply were abundant. But beneath the surface, physical tightness was becoming increasingly apparent to those who required actual metal. Among the most exposed were Japanese manufacturers. Japan is one of the most technologically advanced economies in the world, and silver is a critical input across its industrial base. It is essential for solar panels, electric vehicles, semiconductors, advanced electronics, and precision components. Japan produces virtually no silver domestically and depends heavily on imports. Historically, a substantial portion of this supply originated either directly from China or through intermediaries sourcing from Chinese refiners. Over the past decade, China consolidated its dominance in silver refining, processing an estimated 60 to 70% of global mined silver into refined product. This concentration quietly positioned China as the gatekeeper of physical silver availability. For years, this influence remained mostly invisible. But as 2025 came to an end, industry insiders began reporting changes that signaled a fundamental shift. Quiet policy adjustments in China's export framework hinted at tighter control over refined silver leaving the country. Few in Western markets grasped the implications. Yet those implications would soon ripple outward with extraordinary force. On the first day of January 2026, new Chinese export licensing rules formally took effect. These regulations imposed a minimum production threshold of 80 metric tons for refiners seeking export approval. Smaller refiners were effectively excluded overnight, consolidating export authority among a limited number of large, state-connected enterprises. The result was immediate. The flow of refined silver into international markets slowed sharply. Certain categories of silver products became effectively unavailable for export within days. This policy must be understood in the context of strategic prioritization. Silver is not merely a store of value. It is a critical industrial resource required for technologies that underpin modern economic power. Solar photovoltaic panels rely on silver paste to conduct electricity. Electric vehicles depend on silver for electrical systems and battery management. Advanced semiconductors and next-generation wireless infrastructure require silver's unmatched conductivity. China, facing no shortage of foreign currency reserves, appears to have concluded that retaining silver for domestic use outweighs the benefits of export revenue. When Japanese industrial buyers recognized that their primary supply channel was being restricted, the consequences were immediate. Japan's manufacturing system depends on just-in-time inventory models that assume uninterrupted material flows. A sustained silver shortage threatened production lines across multiple sectors. Faced with this risk, buyers moved aggressively into the physical market, willing to pay almost any price to secure supply. Within days, premiums exploded, and the divergence between physical and paper pricing became unmistakable. Reports emerging from Tokyo during the opening sessions of 2026 described a market behaving unlike anything seen in modern times. Physical silver was no longer being quoted as a derivative of futures prices, but as a scarce industrial necessity. Initial transactions carried premiums of 30 to 40% above the New York paper price. Those premiums did not stabilize. As available inventory was rapidly absorbed, prices continued climbing. By the second day of January, multiple independent sources confirmed that physical silver was trading near $130 per ounce in Tokyo. These were not theoretical quotes, but executed transactions between buyers who needed metal immediately and sellers who controlled limited supply. Other regional hubs reflected similar stress. Dubai, long a conduit between Eastern and Western precious metals flows, experienced sharp premium expansion as well. The Shanghai Gold Exchange, which operates on a physical delivery basis, showed internal prices ranging between $85 and $110 equivalents, depending on product form and availability. These prices reflected domestic scarcity rather than speculative excess. Meanwhile, screens in New York remained anchored near $75, creating a visible fracture between physical reality and paper representation. Under normal market conditions, such a discrepancy would not persist. Arbitrage exists precisely to eliminate price differences. Traders would buy silver where it is cheap, sell where it is expensive, and profit from convergence. If silver truly cost $75 in New York and $130 in Tokyo, arbitrageurs would immediately purchase futures contracts, demand delivery, and ship metal to Asia. This activity would drive Western prices higher and Eastern prices lower until equilibrium returned. The absence of this arbitrage tells us something crucial. The metal required to perform it does not exist in accessible quantities. The registered inventory within the Western futures system still shows silver on paper, but much of it is already encumbered by claims, leases, and contractual obligations. Bars that can be freely withdrawn, exported, and delivered into Asian markets are extraordinarily difficult to source. This bottleneck exposes the leverage embedded within the paper market. Analysts studying the structure estimate that paper claims now exceed available physical silver by roughly 378 to 1. For every ounce in the vaults, there are hundreds of ounces promised on paper. This ratio represents the most extreme level of imbalance ever recorded. Such leverage functions only under conditions of confidence and complacency. As long as most participants accept cash settlement and do not test the system, the structure remains intact. But once physical demand asserts itself, the weakness becomes visible. The divergence between Tokyo and New York pricing signals that the futures market is no longer functioning as an effective price discovery mechanism for actual metal. Instead, it is pricing a financial abstraction divorced from physical constraints. This situation presents an existential challenge to the existing framework. When the price required to obtain real silver doubles the quoted paper price, credibility erodes rapidly. Industrial users cannot manufacture with futures contracts. They require metal. As a result, they will gravitate toward markets where physical delivery is assured, regardless of cost. This shift raises the probability of a force majeure event within the Western exchange system. Force majeure refers to circumstances beyond the control of contracting parties that prevent fulfillment of obligations. In commodity markets, it allows exchanges to settle delivery contracts in cash if physical performance becomes impossible. Should such a declaration occur, holders expecting silver bars would instead receive currency at the prevailing paper price. While legally permissible, this outcome would fundamentally undermine trust. A market that cannot deliver its underlying commodity ceases to function as a reliable benchmark. If confidence breaks, repricing would not be orderly. It would likely occur through abrupt gaps as participants reassess risk. Western prices could be forced upward to align with physical markets, not through gradual appreciation, but through discontinuous moves. Those holding physical silver would see immediate revaluation reflecting scarcity. Those holding unbacked paper claims would discover that settlement terms matter more than quoted prices. This divergence also forces a re-evaluation of how price information is interpreted. For years, investors assumed that screen prices represented objective truth. The events unfolding in early 2026 demonstrate that under conditions of constraint, displayed prices can become misleading. The number on the screen may represent only the value of a promise, not the value of the thing itself. This insight extends beyond silver. Any market dominated by derivatives and leverage is vulnerable to similar breakdowns if physical availability tightens. Gold, copper, and energy markets all operate with paper volumes far exceeding deliverable supply. Under normal conditions, this structure provides liquidity and efficiency. Under stress, it creates fragility. Investors relying solely on paper hedges may find those hedges fail when scarcity emerges. The moment of need is often the moment of breakdown. The distinction between physical ownership and paper exposure has therefore become critically important. Physical silver held outright carries no counterparty risk. It cannot default. It does not depend on institutional solvency. Paper claims, by contrast, rely entirely on the integrity and capacity of intermediaries. This does not render paper markets useless. They serve valuable functions in normal times. But the assumption that paper and physical prices will always converge has been shown to be conditional, not absolute. For more than half a century, the global financial system has operated under a fiat currency regime. Money derives its value from confidence and decree rather than tangible backing. Precious metals were demoted to commodities. Yet, in moments of stress, their monetary nature reasserts itself. China-IWR's export restrictions represent a strategic decision to retain tangible resources rather than exchange them for paper claims. Japan's urgent buying reflects the reality that industrial survival depends on materials, not derivatives. The silver market, though relatively small, is exposing broader systemic vulnerabilities. A system built on leverage assumes stability. When that assumption fails, the consequences propagate quickly. Early 2026 may be remembered as the moment when the difference between nominal pricing and real value became unmistakably clear to those paying attention. As this divergence continues, the implications extend far beyond silver alone. What is unfolding represents a stress test of the modern financial architecture itself. The system has functioned for decades on the assumption that abstraction can safely replace substance, that leverage can substitute for inventory, and that confidence can bridge any gap between promise and delivery. The events of early 2026 are challenging each of those assumptions simultaneously. When physical scarcity collides with paper abundance, the illusion of equivalence dissolves. Investors are now being forced to confront a question that has long been theoretical. What does ownership actually mean? A futures contract represents a claim, not an object. A claim is only as reliable as the system that honors it. Physical silver, by contrast, represents final settlement. It exists outside accounting frameworks, outside clearinghouses, and outside emergency provisions. This distinction has moved from academic discussion into practical consequence. If the divergence persists, markets may enter a prolonged period of dual pricing. In such a scenario, paper silver trades at one price reflecting financial liquidity and speculative flows, while physical silver trades at another reflecting industrial necessity and constrained supply. This outcome would fundamentally alter how participants interpret price signals. Hedging strategies would need revision. Risk models based on historical convergence would no longer apply. Volatility would increase as confidence ebbs and flows. Alternatively, resolution may arrive abruptly through repricing. Should Western participants attempt en masse to secure physical delivery, the futures market could be overwhelmed. The resulting scramble would force prices higher until demand is rationed. This adjustment would not be driven by optimism or speculation, but by the mechanical reality of insufficient supply. Such a move would reprice silver not as a derivative asset, but as a scarce material essential to modern infrastructure. A third possibility involves institutional intervention. Exchanges and regulators could modify contract terms, increase margin requirements, or impose settlement adjustments to preserve order. While such actions may stabilize paper markets temporarily, they do not create metal. They merely redistribute losses and defer recognition. History suggests that confidence, once broken, is difficult to restore through administrative measures alone. What makes the silver market particularly instructive is its scale. Silver is small enough that distortions become visible quickly, yet important enough that consequences are meaningful. It sits at the intersection of monetary history and industrial necessity. This dual role makes it uniquely sensitive to both financial stress and material constraint. In that sense, silver functions as a canary within the broader system. The warning signs extend outward. Any commodity market characterized by extreme paper leverage and concentrated supply chains is susceptible to similar disruption. The lesson is not that paper markets are inherently flawed, but that they require underlying abundance to function smoothly. When abundance disappears, structure matters. Claims multiply faster than reality can support them. For individual participants, the implications are deeply personal. Portfolio allocations based solely on nominal exposure may not behave as expected under stress. Diversification across instruments does not guarantee diversification across settlement outcomes. Owning a claim is not the same as owning a thing. That realization may prompt a reassessment of risk, tolerance, and asset composition. None of this suggests an imminent collapse of global finance. Systems adapt, markets evolve, but adaptation often follows disruption. The silver divergence is not an isolated curiosity, it is a signal. Signals are only useful if they are observed and interpreted honestly. Ignoring them does not neutralize their meaning. The broader monetary context amplifies the significance. Years of inflation, expanding debt, and policy uncertainty have eroded trust incrementally. Each episode alone was manageable. Together, they form a pattern. Physical assets that cannot be created at will behave differently under such conditions. Their value is not derived from confidence alone, but from utility and scarcity. China's actions highlight this reality. By prioritizing domestic access to critical materials, it is implicitly acknowledging limits. Limits to supply, limits to substitution, limits to paper solutions. Japan's response underscores the same truth from a different angle. When production is at risk, price becomes secondary to availability. Western markets now face a choice. They can treat the divergence as a temporary anomaly or as information. If treated as noise, existing models remain unchanged. If treated as signal, adjustments follow. Markets tend to reward those who respond early, rather than those who react late. The coming weeks will clarify which path dominates. If physical premiums stabilize and flows resume, confidence may recover. If restrictions tighten and inventories shrink further, divergence will deepen. Either outcome provides data that contradicts assumptions, forces revision. That process is rarely comfortable. What cannot be undone is awareness. Once participants recognize that paper prices can deviate materially from real transaction prices, perception shifts. Trust becomes conditional. Verification becomes valuable. Transparency becomes scarce. These shifts alter behavior even if prices eventually converge. The silver market of early 2026 has already delivered its lesson. It has demonstrated that efficient markets are efficient only within defined boundaries. It has shown that leverage magnifies fragility. It has revealed that price is not a universal truth, but a contextual signal shaped by structure, access, and necessity. Those who internalize this lesson may approach markets differently going forward. They may distinguish between exposure and possession, between liquidity and certainty, between nominal value and real value. Those who dismiss it may continue operating under assumptions that no longer hold. Ultimately, the divergence between Tokyo and New York is not about geography. It is about reality versus representation, about material versus model, about what happens when systems built on trust encounter constraints built into the physical world. That encounter is now underway, and its outcome will shape not only the silver market, but how participants understand markets themselves. Whether the $130 price becomes the new reference point or remains confined to physical transactions, it has already served its purpose. It has exposed the difference between paper wealth and tangible wealth with unusual clarity. That distinction, once seen, cannot be unseen.